Good afternoon, everybody, and welcome to today's Open to Export webinar about the impact of Brexit on the value of a pound and what businesses can do to mitigate this. My name is William Barnes-Graham, and I'm a Senior Content Editor at the Institute of Export and International Trade. Open to Export is a free online service helping small businesses get ready to sell overseas. Through our step-by-step articles and guides, regular webinars, our Export Action Plan tool, and our quarterly competitions. You can find out about all of these on our website at www.opentoexport.com. Open to Export is powered by the Institute of Export and International Trade, the UK's professional membership body for traders. Endorsed by the World Trade Organization and the International Chamber of Commerce as a small business champion, we offer a unique range of individual and business membership benefits, education and training catering for beginners through to master's degrees, and an always exciting and prestigious program of events celebrating UK businesses' exporting achievements. We will be running a live Q&A later in the session, and you can ask questions at any point using the question box on the control panel to the right-hand side of your screen. The general principle here is that we'll only ask questions that are relevant to the broader audience, so we won't be able to go into company specifics as such, but if you do have specific questions, we can refer you to our technical helpline afterwards. For now, though, it is my pleasure to welcome two great speakers from Bibby Foreign Exchange, who are kindly sponsoring this webinar today. They'll introduce themselves better than I will, so I'm glad to hand over now to Daniel Ashley and Andrew Cook from Bibby. Over to you guys.
Morning, William. Thank you for the introduction. My name is Daniel Ashley. I'm an FX dealer here at Bibby, so I deal with a wide array of clients. I've got about 180 or so clients now. And if we could flick over to the next slide as well, please. That'd be fantastic. So we're going to go through today looking forward into the currency markets after Brexit. Obviously, we've seen a lot of changes up until this point, but there's still more changes to come. So we're going to give you, I'm going to give you an overview of what we've seen so far, and then Andy's going to give you an overview of what we've got to come, what we've got to look forward to. But do bear in mind, these are our opinions, and this isn't obviously an exact science. Hopefully this gives you a clearer picture of the way forward. But obviously, if we didn't know exactly what was going to happen, we'd probably be very rich, to say the least. But let's delve into it. So if you could flick to the next slide, please. So the journey so far. I mean, what you can see on the screen is a slide from just before Brexit up until the present day. So I'm just going to run over what's happened up until this point, because as you can see, it's been fairly choppy, to say the least. So I thought it'd be good to give you guys an overview. So the pound fell from the moment the PM David Cameron announced the date of the in and out referendum on the 22nd of February 2016. At that time, sterling was trading just above the 1.42 level on the US dollar and around the 128 on the euro. So quite a bit higher, to say the least, than where we currently are. Though it really already been falling before that, as the referendum was on the Conservative election manifesto. And probably ultimately, in all honesty, the main reason why they got the majority in Parliament. So on to the next slide, please. So in the next 3 or 4 months, immediately prior to the referendum, the pound actually averaged roughly around the same 1.42 US dollar rate within sort of a 1.385 to a 1.475 range. But this was the UK was widely expected, obviously, to remain. It was quite a shock to the market that we did leave. So on the day of the referendum, the press widely reported that the pound fell from around 1.5 to around 3.1 and cited a 12 to 13 really percent one-day drop. In reality, the pound rallied from around 1.45 to 1.50 only after Nigel Farage famously appeared to admit on TV admit defeat on TV really, only for the decision to come out in his favour. So after that, the pound continued to trade lower, and in October we had the infamous flash crash. So on to the next slide, please. This was when the pound hit its lowest level since 1984. So a little while to say the least. Although the exact low is unclear, with many different rates given by the banks ranging from 114 to 119. And that was a question for you actually had, Andy. But why did the banks? Why were they not able to give an accurate rate on that drop?
Well, basically boils down to each individual bank has their own platform, they have their own customers with their own orders, and it's self-interest ultimately. If a bank has a bid from a client at 116 but doesn't fill it, then they're not going to say that was the low. Honestly, if another bank has clients with stops around 115 and they fill them, they have to say that the low is below that level. Ultimately, on a flash crash like that, it all happens so quickly that there is room for error and a big margin of error. So, yeah, that's why that range is quite so broad.
Makes sense. I can still remember that day as Armageddon in the markets, to say the least. So we can go on to the next slide, please. As is often the case with these flash moves, this marks the low of the pound, and then gradually it found its feet. This is a time when the Bank of England was under pressure to raise UK interest rates as inflation was significantly higher than the 2% target through late 2017 and into mid-2018. So the pound rallied hitting the mark of 1.44. That's on the US dollar side. This is also partly due to the market short positions getting squeezed. So obviously when people are selling the market, those positions are starting to close out, which builds the market up. And also that with Brexit, we were looking like we were going towards more of a soft Brexit in nature. So on to the next slide, please. So after the bank did reverse the 0.25% rate cut it had made immediately after the referendum, and inflation, which was largely higher due to the weaker pound in any case, returned to target and even lower. The pound came off the highs, returning to around the 1.25 level, which is we were around that point up until a couple of days ago, against the resurgent dollar. This is when Prime Minister May took personal control of the Brexit negotiations, and markets brought back the pound to the low 1.30 mark. But when she failed to get her version of the withdrawal agreement passed through Parliament, the Brexit deadline was extended from 31st of March to where we nearly find ourselves, 31st of October. This obviously underpinned the pound until the move to the more hardline Brexiteer Boris Johnson took over the premiership, and his do-or-die Brexit or without a deal policies gave the pound, brought under real pressure, to say the least. So markets began to price in the increased likelihood of a no-deal split, and as the seemingly never-ending uncertainty took its toll on the UK economy, the pound eventually traded briefly below the 1.2 level before PM Johnson finally reached his deal with the EU. And I remember when it did drop through that 1.2 level, it dropped through that level way easier than we thought it would. It went into the 119s really, really, really quickly, which is quite shocking to say the least. So if you can go to the next slide, please. So obviously the pound, what we've seen over the last 7 days or so the last 9 days, has risen about 6%. So it's really had some big gains due to Boris Johnson obviously landing a deal with the EU, something that a lot of people didn't think could happen. We've jumped from the 1.22 on the US dollar right up to the 130 mark, which is a huge move, and I think it's the biggest two-day move on sterling in 10 years. So absolutely colossal move in terms of percentage terms. So what I'm going to do is I'm going to pass you over to Andy. That's just a brief overview of what we've seen so far. Andy's going to give you a bit of a more forward-thinking view in terms of what could happen next, where we might see the pound going. Without further ado, I'll pass you over to Andy.
Thank you, Dan. Good afternoon, everybody. We've done the overview like that, the journey so far, as we call it, just to give some idea of certain levels, which we'll come to. But obviously, knowing what has happened doesn't really help us to know what will happen, but it does give us some target areas and areas where we feel markets will look to reach in certain scenarios. We picked this date from several others that the Institute offered us, hoping that we would actually have some sort of certainty now after the EU summit of last week. Hasn't actually worked out that way. We actually seem to have even less certainty now than possibly even in the past. So what we've done is just come up with a couple of scenarios as to what may happen from here and what that could do to the pound. So if we go on to the next slide, if that's possible. Okay, so as the slide says, Brexit with a deal. So this is being viewed currently by the market as the most likely outcome, or at least it had up until possibly yesterday when Parliament voted against the government's timetable for Brexit. But that's why the pound has rallied so strongly in the last couple of weeks, because this was looking very likely. If it were to happen, if it does come to pass, we would expect the pound to jump as high as, well, probably initially as high as 134, 135 in pretty short order. From there, obviously, you do have to take a look at the future agreement and the future relationship, but we would expect ultimately for the pound from there to rally again. And then we're going back to the 142, 144 levels that Dan mentioned, whereby that was the sort of moving average in the build up to the referendum. It was also the highs in the sort of mid or early 2018. So that gives us that target level to aim at. From there, again, purely we would have to look at all the factors that come into it. If Brexit is done effectively, then we would hope to go back to the more mundane reasons behind the currency movements of economics. But obviously at the moment it's all Brexit. So we would see the move to 134, 135, perhaps some sort of pause, and then moving up again, possibly to the low, probably to the low 140s, potentially 144. Yeah. Obviously, a Brexit with a deal is a good outcome for the pound. If we move on to the next slide, if we may. As you can see here, this is a no-deal Brexit. So, while the Rebel Alliance, as the press likes to call them, have been doing their utmost to make this eventuality unlikely, and have done well, they've passed plenty of legislation, but anything is possible these days with Brexit. So if it were to come to pass, we would see a very sharp reversal of the latest move higher in the pound. We'd look to go back to the 120 level. As Dan pointed out, it was very surprising that the way it just dropped through there, as though there was no barriers, no support when it did pop down there earlier this year, or early September, in fact. But we would go to that level. We would expect again have a pause, see what's happening. But in all likelihood, the pound will continue to remain weak. In this event, if you do have all the queues at the borders, the medicine shortages, the food shortages that some tell us to expect in this event, we would see a further weakening of the pound. We could go as low as 110 to the dollar. People are talking parity against the euro. We don't see it going quite that low, certainly euro-wise, in as much as whilst a no-deal Brexit is clearly bad for the UK, it's clearly not very good for the Eurozone either. So perhaps slightly more pronounced weakness against the dollar, but certainly weak pound overall on in that eventuality. If we go on to the next slide, please. So this is actually beginning to look more and more likely now. We get an extension and then a UK election. We had hoped to know by now, obviously, whether or not what was going to happen with this. The EU extension or the Brexit extension, they're now talking about possibly we find out about tomorrow. So this could be redundant already by this time tomorrow. But we are expecting to hear, and markets are expecting a 3-month extension to the 31st of January. We are unlikely to get an election within that time, although it's not impossible. But that depends. There is talk within the government, or there is apparently disagreement within the government as to whether to push ahead with trying to get the withdrawal agreement passed, or to go for the election. But that is actually out of the government's hands. So in all likelihood, we're just going to get the extension and push for the deal. If we do get an election, there's a couple of different, obviously, outcomes, and they would affect the pound differently. The most likely we see as to be a small working majority for the Conservatives. That will probably generally cause a slight rise in the pound. We would probably have a bit more certainty, and we would anticipate to get a deal through and to move on that way. Strangely enough, the most favourable outcome for the pound would in fact be the Lib Dems, because they would simply cancel Brexit, revoke Article 50, and at that point, I guess you have to look at levels, sort of pre-referendum levels before even the announcement of the referendum, and it's possible we see the 150 level again. I mean, that would be extreme, but markets tend to overshoot. But that would be the 100% best move for the pound. Although obviously then we have Lib Dem policies which may or may not be too market friendly. A Labour government, were to win, they have really not come down either way on Brexit, so we would probably expect to see a second referendum in their manifesto. That in itself would be good for the pound, although we go to polls in that instance and we have to see how they turn out. Obviously, the polls prior to the first referendum didn't give us much of a clue, because they were wrong, pure and simple. Pardon me, just moving on to the next slide, if we may. We don't see this as enormously likely, but it's possible that we would have a hung parliament, probably with a majority or a minority government of the Conservatives, but coming into power of a coalition with the Brexit Party, because let's be honest, the Brexit Party are going to, if Brexit isn't done and signed, sealed by the time we get the election, then the Brexit Party is going to take a lot of Conservative votes. So that's possible. Obviously, that in itself brings about a much higher likelihood of a no-deal Brexit. And we're back to the no-deal scenario, down to 120 initially and then possibly lower. I can't imagine that the markets would take that kindly to a Brexit Party, populist party like that being part of the government. So we would look at a weak pound going forward from there. In terms of Brexit, that's kind of it. But if we do have to remember that once we get any sort of clarity on Brexit, then we do move on to, as I said earlier, the more mundane economic projections and interest rates in the various countries. So it's worth mentioning, obviously at the moment, the US interest rates, they are expected to be cut next month again. This is due to political pressure on the Fed by the Trump administration. Obviously, everyone's heard about the Chinese trade dispute, the US-China trade dispute. President Trump wants a weaker dollar. He can't actually come out and make it a policy, but what he can do is try and weaken the dollar in order to make US manufacturing more competitive overseas, make the goods more attractive, and hence that could obviously strengthen the pound against the dollar. If we look closer to home in the Eurozone, they currently already have negative interest rates for bank lending. There is talk of further interest rate cuts if necessary, and the economic picture over there is pretty poor. Germany, if not already in a technical recession, there's certainly very big fears amongst the Bundesbank and the German economic sector that will happen soon. The trade dispute has really taken its toll on German manufacturing. They're printing money again. That starts next month, in fact, the resumption of printing money. So again, all of this is should be leading to a very weak currency. I think Brexit has masked it to a certain degree, but if you look at the euro to dollar rate, I think that hit a multi-year low as early as I think 2 or 3 weeks back, and it's slightly above those levels now, but it's still historically relatively low. Draghi has actually just had his last press conference as the head of the ECB. He's passing on to Marion Lagarde, who was the ex-IMF head, and markets are viewing this as very much same as the in with the old, out with the old, out with the old, in with the new. Even we'll get there eventually. She's seen as very much a steady hand, but the euro will probably depend on how much fiscal policy the governments, the separate EU governments, can bring to bear, especially Germany. Without that, we would expect to see further weakness in the euro. So, as I say, once Brexit is done, we have to look beyond that economics, and we actually think the pound, from its fairly historic low levels, would be in good shape. So there is, we think, a lot of potential for the pound, but it does all depend on how Brexit pans out. And that really is what I've got. So if I can just hand you back to Daniel, just to run you through the finish.
Yeah, thanks for that, Andy. That's really interesting. I thought the bit I picked up from that is that at the end of the day, we're with the US trying to actually decrease, bring down the value of the dollar to make it more advertising to the wider audience, in a sense. We've basically got that in the UK, so we've actually already had a massive devalue of the pound, which obviously makes your guys' goods really advertising to an international audience. So that's already happened in the UK. I mean, this move that we've seen off the back of Boris Johnson getting a deal, unfortunately, has moved out of your favour. But that also shows you how quickly the market can take out costing levels that you might have. So it's imperative to set wide costing levels, especially if you're receiving goods in 6 months, 12 months, whatever it might be, just in case. Because at the end of the day, we're still relatively in limbo on the markets, which is what I've been saying to our clients for a little while now, waiting for some form of certainty. We've had a little bit of certainty, but it's not been solid. And obviously, we're still going to have quite a bit of movement to come, to say the least. But thanks for that, Andy. I'm sure you guys receive some of the market updates that Andy sends around. So Andy sends around the daily market updates, which is really interesting, which basically keeps you abreast on everything that's going on in the markets, mainly the majors like the sterling, the euro, the US dollar, and so on and so forth. So it's definitely worth keeping an eye on. But obviously, lots of options there of how we can proceed. One thing that I've learned throughout this Brexit process is that whenever I think something, whenever I'm sure that I'm certain of an outcome, something seems to change, doesn't it? So
very much so.
It's never changing landscape, but obviously that makes it harder for you guys to trade in that as well. So if we can go on to the next slide, please. I just wanted to give you guys an overview of who we are, who we deal with as well. So we're obviously Bibby Foreign Exchange, part of the Bibby Financial Services Group. So we deal with all range of businesses, small to large, from your PLCs down to your small businesses. We don't discriminate in that fact. With us, you get your own dedicated trader as well. So someone who watches the markets for you, lets you know when rates might move in your favour and when might be a favourable time to exchange as well. Also access to spot and forward markets. So spots are basically just normal transactions, same day transactions, over to your supplier or the other way around, straight back to your sterling bank account, or whatever it might be, as well as for contracts, which I'll touch on in a second. Also market orders, so that's where you can put a strike rate into our system. That can be quite good, and especially when we're seeing really choppy markets at the moment, it can be quite good to to try and get in just at the top. Obviously, if you've got in at the top all the time, that'd be nice, but it can be a very useful tool to try and get a little bit more out of your money. And obviously, we've got wider finance options available through the Bibby Financial Services group as well. So we can go on to the next slide, please. Fantastic. So one of the good ways to help mitigate some of this risk of trading the currency markets that we're seeing at the moment, and mitigate risk is one factor, but also just provide some certainty, is forward contracts. So this is a hedging tool. It's basically where you can reserve a rate for a certain period of time and for a certain amount of currency as well. So we're starting to see on my side, well on our side generally, just through Bibby FX, a lot more people are taking up hedging in this market, because at the end of the day, your costing levels can get wiped out so quickly, because seeing even a couple of cent move in a day, obviously on a couple of 100,000, is a lot of money that's changing hands there. So if we can go on to the next slide, please. So with forward contracts, it's fairly easy to set up. So we do offer mostly 0% deposits on our forward contracts. So that basically means you have to put no collateral down, you don't have to tie up any cash flow or anything along those lines. You can go as far as 12 months forward as well, in certain cases more. So we normally take it on a case-by-case basis. So if you newly have orders next year, for example, you can reserve that exchange rate for that day next year, which is nice. Also helps, just generally mitigate some of the risk of trading the currency markets and provide you with some certainty to let you know where you are. I mean, just to give you an overview of how my clients are playing it at the moment, a lot of them anyway, if they're not covering their full exposure, which in the market is I suppose a little bit risky in itself, but they're covering a portion of their exposure. So they might take, say for example, if they've got they know they've got funds coming in next year, they might cover 50% of that and then leave the rest of the market to see how the market plays out, just in case of any eventuality, because obviously the last thing you want is to be caught on the wrong side of the market, like you so easily can get at the moment. So that's about it from us. I know we're going on to some questions, so we can flip over to the next slide. I have put my email up on here, so if you guys do have any direct questions or anything like that, that's my direct dial as well. Obviously, I won't be there yet, but when we finish the presentation, please do feel free to pop me a call or drop me over an email. We'll be more than happy to help. And I know we've probably got some questions coming in from you, William, as well in a second.
Yes, thank you, Dan, and thank you, Andrew, as well, for the presentation and the advice there. I hope everyone's found that useful. As Dan notes, we are going to answer some of your questions now, so please do remember that you can ask questions at any point using the question box on the control panel to the right-hand side of your screen, and we'll share Dan's email and contact afterwards as well. So just a quick one which came to mind for me actually is that obviously when we leave the EU or when the deal gets passed, there will be a period of certainty on that phase of the negotiations. Well, then we begin the negotiations for the future trade relationship with the EU. Have you done any thinking or do you anticipate any kind of major factors in what can influence the value of the pound going ahead then when we're on to the future trade relationship negotiations?
Well, to be honest, it's taken 3.5 years to get to the stage of a potential deal. There is certain elements in this deal relating to the future arrangement or the future trading arrangement and relationship. Partly this is why, or at least they claim that it's not getting through the House, because there are less stringent relationship or equivalence with things like employee rules, even so much as the green rules and carbon emissions, this sort of thing. That is going to be we'll have to just take that as it comes. Once, assuming we get a deal agreed, we would expect, as I say, a higher pound. there will be tough bargaining, and there will be days when it looks like the future arrangement is going to be quite rocky, and I would imagine there will be days when it looks as though it's going to be plain sailing. Ultimately, there will be a transition period, where much of that those talks will happen. I generally don't see it being hugely different, if I'm honest. Everybody would love to have a perfectly free trade arrangement. The EU would like it, but they obviously have their own red lines. We would like it, but we have our red lines. But it's going to boil down to, I expect, not to be a huge amount different. There will be obviously some Irish border issues. We all know that that's been the main sticking point. But yeah, I genuinely don't think there's going to be much difference between now and anything that gets erased in the future. But that is going to take some time. So there will be as I say, there's going to be a transitional period. That could be anything up to 3 years. Again, we've got to just see what comes from the politicians, which anyone that's made a habit of predicting what they're going to do recently is probably quite a bit poorer, I would imagine. So, as I say, I'm sorry it's a bit vague, but there is so much uncertainty on that still.
Absolutely. I think even when we know how long the transition period was supposed to be, I'm sure it will be a bit longer. Who knows?
Yeah,
Anyway,
in all likelihood.
we had a question in advance from Susan, who just asked, do BB provide low-cost solutions to allow UK SMEs to bid fixed price in dollars or euros? So getting to the nitty-gritty now.
Again, I'll take that one. Thank you, William. In terms of a low-cost solution, as Daniel mentioned earlier, we do a forward contract solution to fix the price of the currency that you're going to be receiving if you're exporting away. We do, in 99% of cases, we do this deposit free, which is about as low cost as you can get. The cost here is the exchange rate. If you can fix an exchange rate, say currently, I believe we're around 116 to the euro. If you can fix for you to receive euros at 116 or thereabouts for the next 6 months, and the Brexit deal happens, and we go up to 125, then you've made a significant saving. What we can't sort of turn around and say to you, look, it's 116. If you come back in a week's time, it will still be 116. That's in terms of a fixed price. If you mean in those terms, we can't do that. We do everything against the current market rates when we fix a rate for anybody. So we've got as low cost as we can, in as much as we can do it most of the time for nothing. But the rate itself will depend upon the market. As we said during the presentation, we do feel that most people are assuming it won't be a no-deal Brexit currently. So if we get some form of deal, we expect the pound to strengthen. So if you have got longer-term receivables from overseas, we generally like to think that it's probably a good time to lock those in, if that answers the question.
I think a thing to take away from that as well is that in terms of holding a rate or anything like that, I mean, yes, we can do the forward contracts, but in terms of holding a rate at the moment for a client, even for 10 minutes, it is getting tricky. I mean, I've had it multiple times in the last few days where clients have said, I'll get back to you in 10 minutes, and by the time they come back to me, the rate's gone. So it really does move that quickly at the moment, and it's coming to the point where the markets move even off the back of rumours that are coming out, that comes up on our bank platforms as news. So it's an ever-changing market. Yeah, it sounds like forward contracting might be a solution for you guys, just to help protect your costing margins.
Great, thank you. We had a follow-up to that actually from the same person who's asked, what if the forwards is used for bidding and the contract is then not won?
So that's so what we basically do when we reserve a forward contract is we go to the market and secure the funds for you. So we actually reserve the funds. So at that point, if we secured the contract and it came to the point where you didn't win the contract and you didn't need the funds, that we would have to sell that contract obviously back to the market. So at that point, it would either be in a profit or a loss. So if the contract was in a profit, then if you settled in full, we can return that back to you. If it's in a loss, then we basically obviously you're liable for the loss. So it's a bit of a 50-50. I mean, at the end of the day, we wouldn't say to our customers, if you don't have the contract, we wouldn't say to reserve the currency, because obviously it is too risky. But once you do have the contract, then it's better to do it at that point.
And if I can just add to that, thanks, Dan. We do recommend that obviously if you're bidding for some overseas business, come to us, ask us what if the funds will be coming to you in 9 months' time, ask us where we can lock in a rate. And the fact that you have a dedicated dealer, as Daniel mentioned earlier, if the market starts to move, we can update you on that. So we become your eyes to the market effectively. As Daniel pointed out, the movement at the moment in the market is extremely volatile. Historically, volatility is running at all-time highs, probably since the 2008-2009 crash. So if you do ask us prior to bidding for the business, we then know we can keep you posted on any significant movement from there on. But yeah, so once you start your budgeting, if you come to us, you can budget off a realistic exchange rate, and then we can keep you posted as well from there. Okay.
Great, thank you. And we had a question in from Francesca. She asks, if we quote in euros now for orders next year, how can we secure the euro rate? And how are we secured if the rate highly fluctuates? It's a bit of a follow on again, but yeah.
Yeah, no, it'd be pretty similar, exactly the same. So you can secure that 3-4 contracts with no deposit with us, basically. So if the rate moves, at the end of the day, you're still going to achieve that rate. So whether the rate goes up, whether the rate goes down, you still know exactly what you're sitting at on that 4 contract. So you've reserved that currency. Hopefully, you've obviously got it in above your costing level, which gives you a bit more margin on your sale of whatever it might be you're exporting, whether it's goods or services. And yeah, it just helps you provide with some certainty, because obviously leaving that between now and next year, a hell of a lot's going to change, to say the least. So it's basically a certainty tool, in a sense, isn't it?
Yeah, it's peace of mind. It's the way we look at it. It's peace of mind. You know what your receivables are going to be worth in sterling terms. Leave the market speculating to the people that get paid to do that. That's not us, by the way. But it is peace of mind. You know what your receivables are worth at any point in the future. You may, the market may move, the pound may weaken, and potentially you may have been better off not to have done it. But at least you know in advance, and you can budget accordingly. That's the way we see it.
Great. Thanks, guys. And back to the big picture, crystal ball sort of stuff. We've had a question in from Rick, who's asked, are Bibby predicting any shifts towards cryptos while things are so uncertain with the pound, euro, and dollar? There's a big one for you. What do you reckon?
It's quite funny, because I think every single time I've done a presentation, there's been something along cryptocurrency. No, I don't think we're looking to delve into that market. I mean, we do have our eye on it. The volatility in the pound is one thing. Volatility in the cryptocurrency market is definitely a whole new beast. So it's something we do have our eye on, but no, it's not something that I think we'll delve into in the near future. Put it that way.
It's if we look at the crypto market, it's totally unregulated currently. Everybody's heard not the scare stories, the true stories of exchanges disappearing overnight along with everybody's money. The technology behind it is certainly interesting in terms of international payments and any form of payments really going forward. But I think you've probably heard, or you may have heard in recent months, Carney, for instance, has spoken out against cryptocurrencies purely on the regulation front. It's the wild, wild west. Maybe in years to come, there will be some form of government crypto, but all of the sort of, the Facebook Libra, for instance, the governments are pushing back against that already, purely on the basis of the misuse that can be sort of used for in terms of money laundering, terrorist funding, that sort of stuff, because it's anonymous. Governments aren't going to let that one go too far. At the moment, it's literally a roulette wheel. So, as I say, the technology behind it could become part of international payments, but the actual bitcoins and other Ethereum and all of these other things will probably fade, we believe.
Okay, thanks guys. We're not getting too many more questions coming through, so I think on that note, we'll probably wrap up. So thank you once again to Daniel and Andrew for the presentation and for the answers there. Thank you so much.
No worries at all. Thanks, William. Cheers.
Great. So if you can, in terms of what the Institute of Export and International Trade are up to at the moment, we are running several Brexit-related training courses in the lead up to next week's deadline, or not, many of which are fundable by government grants. I'm sure you won't need reminding of the enormity of what is ahead, but you really do need to ensure you've got the core export skills that you'll need, including completing customs declarations. So please do have a look on the site for the funding that's available for our training courses. And we are also doing lots of training around the new Incoterms 2020 rules, which are coming out from the International Chamber of Commerce. We're running several training courses there, so do have a look at export.org.uk/training. And finally, we are looking at doing our final World Trade Summit of the year in November. That's going to be in Birmingham, and that's a chance to hear from global trade experts and network with fellow exporters and members of the Institute from the West Midlands area. So do have a look on the site for that as well. Next, please. And in terms of Open to Export, we've got another webinar coming up tomorrow morning at 10 a.m. and that's about the new Incoterm 2020 rules and changes that are coming up and what exporters need to know about them. Further ahead, we're also going to be looking at how exporters can reach international customers online through Amazon, and that's taking place on November 14th. You can find details about all of our upcoming and our recorded webinars at opentoexport.com/webinars. Next, please. Finally, we are currently running an export action plan competition with Bibby this autumn. This is a great opportunity for SMEs to win £3,000 towards their export plans, and I really do suggest that if you are new to export and looking for some funding, do have a look at this competition. It's a great opportunity. The deadline to enter is November the 5th, ahead of a showcase final at the aforementioned Birmingham World Trade Summit on November 28th. For more information, please go to opentoexport.com/info/export-action-plan-competition. But that is all from us today. We hope you found that useful, and if you have any concerns or questions about Brexit or anything else, please do get in touch. But for now, goodbye.